Everyone seems to be asking the same question right now. When is the market going to crash? And I get why. Markets have gone up a lot over the past few years, and especially in the US, valuations look stretched. But here's the problem with that question. Market crashes are impossible to predict, and they're a normal, regular part of investing in the stock market. Which means that if you're spending your time trying to guess when the next crash will happen, maybe by watching hours and hours of doom and gloom videos on YouTube, you're likely focusing on the wrong thing. Based on my own 9 years of investing in stocks through low-cost ETFs together with my wife, I've learned that focusing on what is actually in your control is a much better use of your time. So instead of asking when the next crash will happen, I think a much better question is this. What actually causes problems when markets crash? Because after living through several big drawdowns, trade fears in 2018, the COVID crash in 2020, the 2022 bear market, and the tariff panic in early 2025, I've learned that crashes don't destroy portfolios by themselves. What really causes damage is when something in your setup fails at exactly the wrong moment. And if we understand what tends to break, we can prepare for it without having to predict anything. One reason market crashes feel so shocking is that many investors underestimate how often markets are actually down. Looking at the US stock market dating back to 1952, it's true that the S&P 500 has spent 44% of its trading days within 5% of an all-time high. But this also means it spent more than half, 56% of the time, down more than 5% from its peak. So drawdowns are actually quite common and not as rare as you may believe. In fact, since 1950, the S&P 500 experienced an average yearly drawdown of minus 14%, yet still managed to return an average of 11% per year since then. Even 30% drops, which we call market crashes, happen more often than most people expect, roughly once every decade based on historical data. The latest examples were the COVID crash in 2020, the financial crisis in 2008, and the dot-com crash in the early 2000s. If hearing about this surprises you, you might simply have the wrong expectations. Most people enter the stock market expecting smooth, consistent gains, but that's not how investing works. Volatility, so the ups and downs, is the price you pay for the higher long-term returns stocks have historically delivered compared to safer assets like bonds or cash. The stock market has this strange ability to produce both strong gains and sharp volatility within the same year. But there will also be periods where it takes quite a while for markets to recover. And based on history, one thing is for sure. The market will continue to test your patience. And that's why preparation is so important. Because a market crash is only dangerous if it forces you to make a decision. And in my experience, the worst decisions don't come from bad investments. They come from being forced to act under pressure. One of the most common reasons people get into trouble during market crashes is a lack of liquidity. You don't want to be in a situation where you're forced to sell stocks or ETFs while the market is down just to cover your living expenses. There's a big difference between choosing to sell and being forced to sell. Selling because your strategy tells you to do so is one thing. For example, when you're rebalancing between different asset classes. But selling because you urgently need cash is something very different. In our own case, my wife and I keep a safety buffer on a high-yield savings account that allows us to cover all our expenses for around 6 months without having to touch any of our investments. And as we move closer to early retirement and decide that we don't want to work anymore, we'll gradually increase that safety buffer further. Not to time the market or to be clever, but so that during market downturns, we can draw from that cash buffer first, helping us stay relaxed and lowering the chance of us having to sell some of our investments at the wrong time. A crash is only dangerous if you're forced to sell. Another very powerful tool is a simple mental stress test. Imagine we're in a crash right now. Your shares just dropped 30% over the past few months. What used to be a 100k portfolio is suddenly worth only 70,000 euros. Now imagine reading headlines about a recession, about people losing their job, and that this time may indeed be difficult. different. How do you feel? Are you able to stomach this scenario and keep holding your investments until markets eventually recover? Or do you feel an urge to panic, sell, or completely change your strategy? Because if this thought experiment makes you want to change everything, your current investment strategy is likely too aggressive for you as you're taking on too much risk. If that's the case, don't worry. This is useful information. Here's why this matters so much. Most people discover their risk tolerance at the worst possible moment, when they're already down 30% and panicking. At that point, it's too late to adjust, because now you're making emotional decisions under stress. But if you run this thought experiment now, while markets are calm, you can make rational adjustments before you feel under pressure. If your setup stresses you out during downturns, being more conservative could actually improve your long-term results. Not because conservative, meaning lower risk portfolios, perform better long-term. Generally, they don't. But because a strategy you can stick to will almost always outperform a theoretically better strategy, which you abandon at the worst possible time. For some investors, this might mean reducing volatility, for example, by using all-in-one ETFs like Vanguard Life Strategy, which include bonds in addition to stocks, and regularly rebalance this allocation internally. Their inclusion of bonds will smooth out the ride compared to pure equity ETFs, which may make it easier for some investors to hold on to them when the market drops. You could, of course, also add a certain percentage of your portfolio to a bond ETF or your money market fund on your own and reduce your investment portfolio's volatility that way. Speaking of ETFs, you can find my favorite low-cost brokers in Europe linked down below, which is a great way to support me if you'd like to. Another problem that often shows up during market crashes is concentration. Being heavily invested in a single country, sector, or team could significantly increase regret when that area underperforms the market as a whole, like what happened to Japan for several decades following its outperformance in the 1980s, or the tech-heavy Nasdaq 100 dropping over 80% from the year 2000 to 2002. While it eventually recovered and went on to do very well, honestly ask yourself, would you really have been able to stay invested and stick to your strategy throughout that horrible crash and wait a grand total of 15 years for it to break even? Most people probably couldn't. And that regret often leads to some of the worst behavior, constantly changing strategies and jumping from one idea to the next. That's why, for me, global diversification isn't about maximizing returns. It's about minimizing regret. It's about increasing the odds that I stay invested through all market cycles, not just the good ones. The goal shouldn't be to always own the best performing market or sector, as that is an impossible task. It's to avoid owning the worst one at the wrong time. And if making specific changes like lowering your overall exposure to US stocks by adding an MSCI World X USA or Stocks Europe 600 ETF makes you feel more comfortable and increases the likelihood that you'll stay invested, then there's absolutely nothing wrong with that. But the one thing I wouldn't do is to exclude a large portion of the market completely based on how you feel about it right now, because that is something you're likely to regret at some point as things change. Which brings me to something powerful you should seriously consider as a long-term investor. Set a simple rule for yourself and stick to it. Perhaps even write it down somewhere so that you can look at it when markets get ugly. I will not sell in a crash, no matter how scary the news headlines are. Selling during a crash locks in damage that can be undone. To make things worse, in some countries like Austria, where I live, you can't even carry losses forward to the next year. Most long-term underperformance doesn't come from paying too much in fees or the wrong ETF choice. It comes from a single action, letting emotions take over during difficult periods in the market. And there will be plenty of those periods. When the next crash hits, and it will, try to look at your strategy with a calm mind. Remind yourself that you're investing for the long run, and that short-term price movements are not a reason to constantly rethink what you've been doing. Whenever you're in doubt, zoom out. Look at the longest possible time frame for the index you're investing in. Remind yourself that a lot has happened over the past decades. Wars, recessions, bubbles, financial crises, and crashes. And yet, Over the long run, markets recovered and continued to move higher. Preparing for a crash doesn't mean trying to predict when it's going to happen. Nobody can do that successfully, so there's no point in wasting any of your valuable time trying. It simply means making sure that when it happens, nothing in your life forces you to do something you're likely to regret later. If you get the basics right, like having the right expectations, enough liquidity to weather the storm, and a strategy you can actually stick to, the next crash will still be uncomfortable, don't get me wrong. But it won't derail your long-term plan. And that's really the goal. Not to avoid all volatility or to perfectly time the markets, but to build a setup that's resilient enough to survive whatever the market throws at you. My wife and I have been through several significant drawdowns over the past 9 years. Each time, our strategy remained the same. We simply continued buying and holding a global ETF every single month, while keeping our emergency fund at the right level for us. This approach has served us very well so far since 2017, as we made sure nothing in our setup could force us into making a bad decision whenever markets got scary. And when the next crash inevitably comes, we'll do exactly the same thing. Now, do you feel prepared for a crash whenever it may come? Or does the thought make you realize you need to change something? Let me know in the comments. As usual, you can find my favorite low-cost brokers for ETFs linked down below, which is a great way to support me if you'd like to. And if you want to know how not to invest, featuring an expensive mistake I've made, this next video is for you. As usual, none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.